Yeah, it's just rude to shoot a video with glasses. Grant Cardone said that.
For real?
All right, so you've been getting into options.
Yeah, so option trading in a nutshell is instead of leveraging your full budget on one particular stock, you're gonna buy a portion of the stock, which is called an option. And what you do is every option is worth like a small fraction of the actual overall stock.
So let's just say I'm starting out and I have $100. Is that good? Or do you need more?
For me, I started options. I stick around $200 with my options. The reason being, I don't want to do more than that because when options. So if you end up losing your bid, like, and what I mean by that is if you go out of the money. All right, so I'm gonna
if you
explain.
lose, you got to break it down. Like,
all right, so
because I don't know how to do it either.
I'm gonna explain some terms first.
Okay.
So in the money is when your option is floating above the actual money. When you're actually buying the option, so you're buying to open, right? So what that means is that you are the buyer, right?
Okay.
The seller will be what you call, like, say, puts.
Okay.
So me as a buyer, I'm gonna go buy to open, right? And what I'm doing is I'm saying that, all right, I gotta keep my strike price. I gotta keep my money above the strike price. And what a strike price is pretty much saying this is the no shit price. If it drops below that price, then you're gonna take all of my options.
You're gonna lose your money.
You're pretty much gonna lose your entire $200 or whatever you put it in.
Okay.
So that's why I don't go over $200, because at $200 in my account, it's a small fraction of my overall account because I've diversified my portfolio.
And just so that I make sure I'm understanding this right, options is when you are predicting the price. You're like, I think that in 30 days.
Not necessarily. So there's a difference
What's
between
that,
like
futures?
futures and options, right?
Okay.
Options, you do have an option deadline.
Okay.
And most, though, typically they have a 7-day.
Okay.
They have a
So it's a quick turnaround.
7-day turnaround. You can pick your expiration date. Your expiration date can be 14 days out. It can be 20 days out. They have several different option contracts, right?
Okay.
It's called option contract chain. So in that chain, you're gonna have different dates, right? And you're gonna have a cluster of different options to buy. And with those options, why is it a cluster? Is because, for example, say like Apple is at $160 per share, right? It's just an example. Then the strike price is, say, $155 is the strike price, which means that if Apple drops below $155, that was the no shit strike price.
You're gonna lose your money if it drops under 150.
It's a couple of different things that needs to happen though. First, you need to meet the date. So if you did a 7-day option chain, then on expiration of that date, at the end of that contract date, and it dropped below 155, that's when you hit your strike price. So anytime between that 7 days, if it drops below 155 and back up, that's no problem. That's fine. You're not gonna lose your money.
Okay, that makes sense.
You lose your money
on the
on the expiration of the contract.
Okay.
Now, on the flip side, if say you're in the money, which means that you're above 155. Now, like I said, you bought it at when Apple was at 160, which means you were already in the money. So if you go above that, anything above the strike price at time of purchase, you're gonna multiply your dividends pretty much, or you're gonna multiply your earnings.
So
I'm gonna do a better video to actually explain this, like, from all the terminology.
Let's just do a video series and we can hop on the computer.
Yeah.
And then we'll just do.
You know what I mean? So I can actually break it down as far as how it looks as far as.
You gotta get over here, right?
Yeah. So I'm trying to get over this. He acting like he don't know. So yeah, I'm gonna redo this one because it's gonna confuse people when you start out like that. And plus, I want to draw on the board too.
All right, so pretty much you're getting, if Apple's 160, you're getting it for $40.
So different option chains, you can get them. Say it says 40 cents, right?
Mm-hmm.
Well, every option chain comes in a bundle of 100.
Okay, so it's a lot.
So you're always gonna get, the quantity is gonna be 100 shares.
And you're getting them for 40 cents each.
For 40 cents each. So you see what I'm saying? 40 bucks,
40
right?
bucks. Okay.
So for most people, if I'm dealing with $200, then you already can see that at 40 bucks, I'm gonna buy at the minimum 4 contracts. You see what I'm saying? Because at 4 contracts, that's what? 40, 80, 120, 160. Why don't I go to 200? Is because you're gonna have to pay your actual fees,
Like commissions.
your commissions for actual trading commissions, right?
Okay.
So a good rule of thumb is, if you want to buy 5 at 40 cents, right? If you do want to end up buying 5, then instead of putting in $200, put in like say $215 in your TD account or whatever your trading
fees.
account, right? Have like $215 to play with for your options. Every time you do options, have like $215. That covers your commission fees, and you can still buy 5 contracts, whatever, if it's at 40 cents. Because some of them might be even lower than that, right? You could get contracts at 20 cents, right? But for me, I want to max my $200 out. So it doesn't matter what the price is. I'm still going to try to max it as close to $200 as possible.
Okay.
Which is why you want to make up for the commission fees.
So what do you get when you're above the money and you hit your expiration date?
So say for example, we're at that 40 cents. We bought it at 40 cents, right?
Right.
Don't look at the overlying price of 160, right? You don't care about that. The only time you care about that is if it's a strike price, right? But your 40 cents, as the big stock goes up, you're gonna get your actual options are gonna go up as well. That 40 cents goes to say 90 cents. You know, so you've more than doubled.
You could double your money.
You more than doubled your money on your 1 contract, and then you multiply that times your 4 because you bought 4 contracts. So that's how that would work. As far as how the money works is if you buy more than 1 contract, you do the math. First, you do the math. How much did it go up? It went to 90 cents because this is a true story. It just happened on Tuesday morning, right? I had a stock, and I bought options in it, and it went to 90 cents, right? It went to 90 cents. That 50 cents it went up, I multiplied that times the 5 contracts I bought, and I took all of my earnings because I set triggers to go ahead and sell it if it goes to a certain price point, and I think a lot of people do that.
Mm-hmm.
You set triggers for yourself so that you don't
so you lock in your profit.
You lock in your profits, and also you don't get too greedy. Because you don't want to get too greedy and try to shoot for the stars and think that you're going to go up like quadrupling.
So you could double your money, which is way bigger than just getting a small percentage. And so my arm is tired, so we're going to wrap this up.
Yeah. we'll edit this in and out, all the good parts.
We'll hop on the
How about that?
We'll hop on the laptop.
All right.
And show it.
Mm-hmm.
Deal.